Hey, this is Brett from Moonstream, and today we're going to talk about a concept called dollar cost averaging that many people are a little bit unclear about and why it's such an important way to trade and to add to your arsenal. Because the big mistake that most retail traders make is they go all in on trades or they go all out on trades. They're sort of buying and then selling. They're getting in and out of positions in their entirety. Professional traders will either get into the markets a little bit at a time, dollar cost average on the way in and the way out. So here's a strategy of how to use dollar cost averaging when the markets may be going down and you're in a position you don't really want to sell all of. If your position starts going down a little bit, it's better to take a partial loss, a partial stop loss, if you will, so that you have powder dry, you've got cash that you can buy back on the bounce. So we're going to cut in a chart here of Injective, which is showing one of our early reversal indicators, a bearish early reversal indicator with the red arrow, indicating that it's probably going to go a little bit lower. So I don't recommend selling all of it here, but let's say that you sold half. In this case, the price is probably going to come down 10% or so. And so if you sell half of your position, it could be a third, it could be a half, but by selling a half of your position, then you've got cash to buy it back down lower, and we show one of the arrows coming down where you can buy it back. That just lowers your break-even cost. Now, some people say, but I don't want to sell here because what if it goes higher? And that's another reason to just sell half the position. The other arrow is showing that if it does break out over this current resistance, we've drawn a red trend line here, where there's resistance now. And if it does go higher, generally these will retest resistance as support. And so what you'll see is that once it breaks out, it'll come back down, and that way you can buy it back there also. The reason this is a risk-reduced strategy is either way you win, because if it goes up higher, you still have half your position to profit from, and then again, usually you get that retest to buy back. It's better to buy back even at the same price or a little higher than you sold, because it's better to buy back into strength and momentum rather than risk price going down 10 or 15 or even 20%, which could be the case here. So hopefully this is making sense. This is what we advise to all of our traders. For more information, go to moonstream.io. And if you'd like some one-on-one coaching help, you can go to moonstreamcoaching.com.